Hello and welcome to Fundamentals, a platform to understand your fund tenets. In this series, we aim to bring to you the minds behind the funds you may have invested in. Today, we kickstart this series by discussing Kotak FlexiCap Fund. It is one of the biggest funds in the FlexiCap category and is being managed by Mr. Harsha Upadhyaya. He has been managing this fund since its inception on 1st of January 2013. He has been able to generate a return of 16.28% annualized since its launch. Thanks, Harsha, for joining in. It's always a pleasure talking to you.
Thanks, Megha. It's my pleasure to be talking to you.
Harsha, each fund manager has a unique style and investment approach to investing. So just to start with, what is your style of investing?
Harsh, our style of investing at Kotak Mutual Fund is growth at reasonable price based philosophy. Essentially, it means that in an emerging market like India, where growth is always a little easier to find, we will have a set of stocks in our portfolio which will be very diversified, but will have a tilt towards growth. And the valuation is also of importance to us. We will not buy stocks just based on the expected growth, but we would also look at what valuations they are trading at. So overall, we are looking at growth at reasonable price.
So while we have understood the approach of Kotak Mutual Fund, taking this discussion a little forward, since we are talking about Kotak FlexiCap Fund in particular, what would be the investment philosophy for this particular fund?
While the overall philosophy is still growth at reasonable price, but we do have both a top-down as well as a bottom-up approach to find portfolio stocks within that. From a top-down perspective, we try to look at sectors which, in our opinion, are likely to outperform in any economic cycle or an economic phase. And within the selected sectors, we do bottom-up research and try to find relatively better stocks, both in terms of growth and valuation in that basket. So that's how we try to make a portfolio for FlexiCap. It has no bias towards any capitalization, as the name suggests. So stocks could come from any of the segments, but from a top-down as well as bottom-up analysis.
You have been involved with the fund since inception. So what is the investor segment that is in your mind when you started this fund, and at present, is there any change in that?
Harsh, there has been absolutely no change in terms of investment style or the portfolio construction, etc., since we have taken over this fund in terms of management. We do believe that this is a FlexiCap fund which has a reasonable tilt towards large caps, not now, but since inception, is something that gives you stability of large caps and also potential upside from a reasonable exposure in mid and small caps. That's how this fund has been positioned. And this would be ideal for all those investors who look for a reasonable capital appreciation by participating in equity.
If I have to put it in number terms, what is the kind of time horizon and what is the return expectation an investor should have while investing in this fund?
While I will not be able to comment on return expectations, I can say that any equity fund that you invest into, the longer the tenor, it's better in terms of expected experience. So to that extent, even here, I would suggest that the investor should come with a longer term in mind. But at least 3 to 5 years at the minimum, because that's when equities will give their full potential in terms of wealth creation. And also, equity markets are inherent with volatility. So to that extent, any volatility that you see could also get kind of well managed within that period of 3 to 5 years. If it is more than that, then definitely it's much better, but at least 3 to 5.
Since you mentioned that your fund is large cap heavy, when we compare different flexi cap funds, we do understand that the returns come in how much weight you have in large cap, mid cap, and small cap, and that asset allocation at times decide the return of the fund. So how do you decide in your fund where would you put your money, relatively speaking, out of these three categories?
Generally, we have believed that a tilt towards large cap gives you better experience from an investor perspective through a cycle. So we have been managing this fund with at least 65 to 75% of large caps, while On a regulatory front, there is no restriction in terms of where you can invest into or how much you can invest into. But internally, we have decided that we will run this fund with a 65 to 75% allocation to large cap and the rest going in mid and small caps. So that's how we have decided our allocation strategy here. And the relative weight of each of these segments would be decided based on the market conditions, the kind of liquidity that you get in some of these segments in different market phases, and also the relative growth and valuations in these segments. So it's a combination of these factors which will decide the allocation between large, mid, and small cap segments.
So Harsha, this is a question which we often get from our investors. You manage the biggest fund in the industry in FlexiCap category. In fact, if we see your fund's AUM, and if you see the bottom 20 funds in terms of size in FlexiCap category, the cumulative AUM of those funds is lower than what your fund is. So the simple question which I would want to ask is size an advantage or a disadvantage?
I would say it's an advantage as well as a disadvantage. First, let me talk about advantages. When we talk about advantages, for the investor, it's going to have the minimum expense ratio as compared to some of the larger funds, because as per the regulatory guidelines, as the fund grows in size or in assets under management, every 5,000 crores of additional assets bring down total expense ratio by 5 basis points. So the larger the fund, the expense ratio is going to be lower. Being the largest fund in the active equity industry, this fund has the lowest expense for the investor. So that's the biggest advantage that you have, especially if you're a long-term investor. Year on year, you're going to be saving on expenses, and that can add to your overall return. Second is the fact that this is a fund which has been in existence for more than a decade and has one of the largest investor bases in the country with over 15 lakh folios. So to that extent, any inflow outflow is very unlikely to make any large, would require any large changes in the portfolio, because you will have a stable AUM as well at all points of time. So to that extent, you need not worry about a large investor moving out or a set of investors moving out or coming in at any particular point of time. So these are definitely advantages as you compare it to any of the smaller size funds, I would say. On the disadvantages, I would say that in certain market phases, the market liquidity may not allow you to buy stocks without an impact cost, especially in mid caps and small caps, more so in small caps. So to that extent, this fund can have higher impact costs if you want to chase some of those stocks in a particular market phase. But as I explained, our investment style, it is more of a buy and hold kind of a strategy. We don't really bet on events, or we don't make tactical choices in terms of our investment. So to that extent, this advantage becomes a lot lesser when you look at it from an overall perspective. So broadly, these are some of the advantages and disadvantages of a large fund, I would say.
Harsha, my next question is taking a thread from your first answer, where you said that your style of investing is growth at reasonable price. Now, there are different cycles of market. At times, it's growth. At times, it's value. It's momentum. It's low volatility, high volatility. So, how does an investor understand this fund and analyze the performance in different market cycles?
I don't think the investor needs to change the investment style based on the phase of the market. It's just that a fund will have a certain investment style. It's not that there is only one investment style that is good or that is bad. It's how disciplined you are in terms of your investment style, how coherent is the portfolio, how good is your risk management. These are the factors that determine overall risk and risk adjusted returns of the portfolio. So to that extent, what you need to do is consult a financial expert, get a fund which has a very good track record, which has a very good investment research support, and which gives you a good experience in terms of overall cycle. So there will be phases in the market where any kind of investment style can have challenges, any kind of investment style can have very good returns. So all those ups and downs will be there. But broadly, if you select a good fund, that should deliver reasonably stable and good returns over a period of time.
So, Harsha, extending this question further, if you could help our investor understand the performance and risk return of this fund over various market cycles that you have managed this fund.
It's been a long time since I've been managing this fund. This fund has more than 12, 13 years of overall tenure in terms of being in existence. If you look at the fund was a mere 300 crore fund a decade back, and now it's the largest equity fund in the industry with more than 36,000 crores worth of assets. So to that extent, it has grown in size, but overall investment philosophy and the style have remained consistent. So what we believe in terms of what will work for the fund, and we continue to follow that process to the T. And uh, despite ups and downs in the market, despite volatility in the market, we do not really change our investment philosophy or investment focus. Continue to do the same thing on a daily basis, and that consistent investment framework has actually helped this fund over a period of time, I would say. But as I said, there will definitely be periods of underperformance, outperformance in every fund, including Kotak FlexiCap Fund. But if you are an investor of a long term, definitely the experience that FlexiCap has provided would have been one of the better ones, I would say. Since inception, we have had consistent track record of beating the benchmark uh, for a long-term investor. So that's something that we are really proud of.
So some of the investors have had really bad experiences in the past 2 to 3 years because of certain accidents which happened at certain fund houses or at a fund level. But you have been broadly avoiding those kind of accidents in your fund. So A, how do you ensure that your investee companies don't have corporate governance issues? That is question number one. And question number two is, you would have taken certain calls in last few years which would have delivered you much more than what you would have anticipated, but certain calls would have gone not as planned also. So if you could give us examples on what went right and what went wrong for you in last few years.
Yeah, as far as governance is concerned, it's of very high importance to us. We don't compromise on governance at all. While we analyze business management aspects other than governance and valuation, etc. But if there is a red flag on governance, we generally try to avoid those stocks. In fact, our investment universe, we try to look at governance issues before including a stock into that investment universe. So at the first step itself, we try to avoid that by making sure that it's not in the investment universe so that it doesn't come into the fund at any point of time. But there could be stocks where governance issues creep up over a period of time. In those cases, obviously, the experience of our team, which has been in the markets for decades and more, gives us an edge in terms of looking at what has been the past track record of that particular company, what has been the track record of the management, and how they have actually dealt with minority shareholders. Are there any other incidences of governance or misgovernance, etc.? So to that extent, this is a continuous process while we try to avoid such stocks from our investment universe. But if a stock comes into the universe and then later, at a later point of time, there is a governance issue, then obviously we keep following that and we keep looking at factors which would reduce some of those issues and try to position ourselves in those particular stocks. But obviously, you can't really guarantee that you will never get into such a problem. But thankfully, we have been able to understand and identify some of these issues much well in advance. And that has led to this fund not facing some of those accidents in the past, as you rightly mentioned. Coming to the second question which you asked in terms of what has gone right or what has gone wrong. Let me tell all the investors that unlike in archery or in shooting, where a bullseye is possible, or in gymnastics, where 10 out of 10 or a perfect 10 is possible, in investments, it's never possible, right? You will have certain calls which will not work as per your understanding, or which will take more time than what you've initially anticipated, etc. So there is always that recalibration that you need to do. In fact, in our business, we say that it's not how many calls that go right is what is important, but how much money you make on those winners is what is likely to drive your overall returns, and also the converse of it in terms of how less money that you lose on some of the bad performers that you have in your portfolio. So to that extent, I would say that over a period of time, there have been number of positives and number of negatives that have been with the fund. Most recently, for example, in the year 2021, we became cautious on the market in anticipation of high returns and in anticipation of high valuation. And we expected the volatility to increase and stocks to fare not so great in terms of next few quarters. At that time, we actually looked at sectors which were very high in terms of valuations, both from historical perspective as well as from absolute perspective. Mid-cap IT sector was definitely one of that, and we completely avoided that sector in 2021. Obviously, there was a period in the early part of 2021 when this sector, despite being high in terms of valuations, continued to move up, and we had to bear that underperformance. But later on, when the markets gave away, this was one of the sectors or the segments which cracked much more than the rest of the market. So to that extent, we were able to catch up in terms of our performance. In fact, we have more than recovered what we lost during that period because of this sector continuously outperforming. So, I mean, that's what I'm trying to say, that there will be few calls which may take time to deliver or which may go completely wrong as well. Then you have to recalibrate your portfolio. But end of the day, you need to see that some of the calls that you have taken gives you more money than some of the calls which have not worked for the fund. That's how you need to manage them.
And that's where I think professional fund management comes into picture, because whenever we see retail portfolios, when they do invest in direct equities, they book their profits way too early and they keep on sitting on losses for way too long. And I think that's where fund managers like you help our investors avoid those mistakes. So Harsha, coming to the last question, investors have seen you, read you, heard you, but we do understand that you are the captain of the team and there is a team behind you which assists you in taking decisions. You could help us understand the fabric of the team behind this fund and what does it constitute and what is the structure of that. That will be really helpful.
Definitely. When you look at a fund manager, obviously the final responsibility of managing a fund lies with the portfolio manager, and also the accountability is with the portfolio manager. But at the same time, there are a lot of inputs that come from the research team that the institution has, and that's how you get a variety of inputs which could be used in the overall portfolio construction. So definitely what has worked for us is the institutional framework within which we manage the risk, some of which I explained to you earlier in the earlier part of the conversation. The second one is about the research team. We have got one of the really experienced research teams in the country today. Some of our analysts have put in almost 15 to 20 years in researching companies from various sectors. These are sector experts, as you would call them. And they have also been in the Kotak asset management team for more than a decade now. So same team and a very experienced team is what brings you that kind of a coherence in terms of investment decisions that we take. Because there is a great understanding in terms of what is the overall investment philosophy of the fund house and what are the risk management frameworks that we need to follow. And accordingly, everyone aligns their overall research inputs into this framework. And that helps in terms of building a very strong portfolio at our end. So I would say that while fund manager may be the face for the fund house or for the fund, there is definitely a lot more depth that comes from the research team. And our 15-member team, which is the really experienced team, is something that we really depend upon.
Thank you, Harsha. That was a detailed one, and that really helped us understand the structure of the team. With this, we come to the end of our podcast, and I'm sure this is going to add a lot of value to our investors whom we have recommended this fund or any other Kotak fund, because being CIO, you would your philosophy would transcend the entire organization as far as equity funds are concerned. Thank you for taking out time on a busy day and doing this for our investors. We really appreciate that. Thanks.
Thank you so much. It was a pleasure speaking to you. Thank you.
Thank you.